The truth is that most of the population under-owns the gold trade. And just capturing the beta, just capturing the amount by which the gold market outperforms the broad market in a gold bull market, argues that investors who aren't willing to do the work, who can't suffer volatility, too much volatility, and can't suffer real risk, need to be in the best end of the market.
As my other mentor, Doug Casey, says, it's a crappy choo-choo train 19th century industry. Why would you invest in that today if your most recent experience with it is a dramatic underperformance? So flash forward to this year, and not only do we have the higher gold dollar exchange rate, I don't like to call it the gold price because in my mind, gold is money. So it's a Forex question. The higher gold dollar exchange rate, it's not just that has pushed up the miners. The miners have actually started delivering.
In this video, RickRule and LoboTiggre offer a masterclass on the commodities sector, discussing their perspectives on gold and silver. Legendary investor RickRule advises average investors to stick with top-tier gold stocks to capture gains in the gold bull market. Rick explains that gold rises first, followed by quality producers and then juniors. LoboTiggre, CEO of IndependentSpeculator.com, challenges the 2024 belief that gold stocks are broken, citing improving fundamentals. Tiggre admits past failures justify skepticism, but says some miners are now delivering real value. Well-positioned junior miners with quality assets can deliver 5 times returns over 2 to 3 year periods, even without significant additional increases in metal prices. These returns typically come through resource expansion, development milestones, and market re-rating as companies de-risk their projects. Gold's rally for the year has driven gold mining stocks to hefty gains. As a group, the 79-stock gold, silver, and gem miners group swung more than 45% higher for the year through June 30th. Newmont and Wheaton. Precious metals showed year-to-date gains of more than 60% on Monday. Unlike the last bull market, miners today are converting higher gold prices into real profits. Tiggre views better-managed producers as delivering stronger margins and performance. He advises against buying broad ETFs like GDX, calling this a stock picker's market. From a technical perspective, Rick agrees that gold stock investing has always required serious effort. He warns that most so-called gold companies lack real assets and will likely go to zero. However, he notes the sector now includes stronger players, citing Agnico Eagle. Agnico Eagle Mines stands out as a leader in the sector, combining quantitative strength, strategic growth, and low-cost operations to deliver consistent value. Agnico Eagle delivered record production, free cash flow, and margins while keeping 2025 cost inflation under 4% and cash costs at $940 per ounce. Before we dive into RickRule and LoboTiggre's sharp insights from their latest interview, be sure to hit the subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
The thesis that the gold stocks were broken is one that was really a 2024 story. And I wrote about it just over a year ago, arguing that they weren't broken. But that, as my mentor RickRule taught us so well, the gold producers in the last big gold bull market managed to turn a 7-fold increase in the underlying commodity into an increase in negative free cash flow. And I went and charted that. It's true. Like he likes to say that took real talent. I'm bringing Rick into my answer here, but I think this is highly material. So the intelligent investor, assuming there are 2 or 3 left still alive, it wouldn't be wrong for them to hesitate before saying, oh, gee, gold's up, gold stocks should go up. The last time, they turned it into greater negative free cash flow. Why would you buy that business? Or as my other mentor, Doug Casey, says, it's a crappy choo-choo train 19th century industry. Why would you invest in that today if your most recent experience with it is a dramatic underperformance? So flash forward to this year, and not only do we have the higher gold dollar exchange rate, I don't like to call it the gold price because in my mind, gold is money. So it's a Forex question. The higher gold dollar exchange rate, it's not just that has pushed up the miners. The miners have actually started delivering. Agnico, as you mentioned, known for excellence of operations, it actually was outperforming even last year. And the other ones that have problems, not so much. And that kept the GDX underperforming. Well, this year, even, last year's underperformers are benefiting from the margins, and some of them are actually getting their act together. And so I mean, it makes sense. The business is actually delivering. And so those people who previously said, well, the gold miners, they flubbed it last time. They dropped the ball. Well, this time they're actually running with the ball. There's a rational basis for saying that, well, now it makes sense. And then, of course, the food chain, the trickle down theory, that actually does work in the mining space. We've seen this repeatedly. So I will push back a little bit on my mentor here and say that obviously better companies have responded with gusto here. So it's really difficult for me to look the audience in the eye and say, yeah, never mind $3,300, $3,400 gold in all-time highs, not just 52-week highs, but all-time highs in a stock like Agnico or something like that. Just buy it. It'll be fine. There is opportunity for correction. And the idea is to buy low, sell high, not to buy high and hope to heck to sell even higher. So as much as I love a company like Agnico, I would buy that today at an all-time high or very near to that. I would look for something that is legitimately still overlooked. And this requires due diligence. This is a stock picker's market now, is basically what I'm saying. I wouldn't buy an ETF. I wouldn't buy the GDX or the misnamed GDXJ. I would look for something that is legitimately bringing value to the market, which hasn't caught on yet. And those do exist. They're out there. But there are ones that you can't say, oh, it's cheap, so that's an overlooked gem. No, there are stocks that are cheap and they deserve to be cheap, right? Lifestyle companies and that sort of thing. So again, caveat emptor, buyer beware. This is a stock picker's market. But if you're willing to do a little work, and hey, if you want to make money, you should be willing to do a little bit of work, maybe a lot of work. I do think there's still opportunities in the gold and silver stocks. But I do think it requires effort here. No dart throwing.
Well, I would respond to Lobo by saying it's always required effort. And what he says about the sector as a whole couldn't be more true. There's probably 1,000 public companies worldwide that purport to be in the gold space, but most of them only have gold as a component of the name on the share certificate. If a commodity rises that you have none of, it shouldn't impact your basic values. And the great majority of the purported gold mining stocks will ultimately return to their intrinsic value, which is zero. Investors make fun of sovereign issuers for inflating away the currency, but there's no industry in the world that's better at inflation, which is to say printing phony paper, than the gold mining industry. That disguises the fact that there are qualitatively better companies now than there were in the decade 2000 to 2010. Remember that the most flagrant abusers in that epoch were allowed to pursue other employment opportunities, hopefully in other industries. I would argue further, as an example, with Agnico Eagle, and we've done the work. If you do a net present value calculation on their future cash flows at $3,200 gold and compare it with the net present value of future cash flows that existed 18 months ago when the stocks were half as high, they're actually cheaper today than they were 18 months ago on a net present value basis. Both Lobo and I have the experience, we have the courage, and we're willing to do the work. So we can go further down the feeding chain than most people do. However, if we're talking to a broad audience, which I know the VRIC has, the truth is that most of the population under-owns the gold trade. And just capturing the beta, just capturing the amount by which the gold market outperforms the broad market in a gold bull market, argues that investors who aren't willing to do the work, who can't suffer volatility, too much volatility, and can't suffer real risk, need to be in the best end of the market. Bull markets follow very, very predictable patterns. The metal, the best of the best of the rest. The junior producers, the developers, the explorers. That's the way it works. For myself, I'm moving way, way, way down the value chain. I'm trying to get as far away from the institutional investors, from the traders, from the ETFs as I possibly can, so that I can acquire large positions in companies that will be acquired and added to the index. That's the way the game works. But this is a game that requires a lot of work, and I have learned at my conference and your conference that most investors are unwilling to do the work required. Most investors would prefer to feel as opposed to think. For them, they need to be in very, very high quality names.
Looking at major fundamentals, RickRule mentions gold and silver stocks may outperform in the short term as they catch up to rising metal prices. He emphasizes his preference for large, undervalued Tier 1 deposits in overlooked regions and commodities. He considers these previously ignored assets highly attractive due to their potential future upside. While gold miners have lost momentum, there is nonetheless reason to remain bullish on gold miners at the start of the third quarter of 2025, as future prospects remain as solid as ever, with several recent developments likely to boost long-term demand for physical gold. Gold is up roughly 25% this year, and gold miners are doing even better, rising more than 50% as a group. But investors still don't care. No one is buying gold stocks, and that tells us this rally will continue. RickRule emphasizes that proven management is crucial in the early stages of mining. For him, great outcomes come from backing skilled, incentivized people, not just stories. Concurrently, LoboTiggre emphasizes that political risk is a major concern in his portfolio. According to him, even diversified holdings can't shield investors from serious disruptions, citing Franco-Nevada's exposure in Panama as a cautionary example. Let's get back to the interview.
If the investor's time frame is short, I think that the gold stocks and the silver stocks have to catch up to the gold price and the silver price. I think we are in a conventional precious metals bull market, which is led by the metal. After the metal, the best of the best follow, and then the best of the rest follow. So if the investor is asking me the question from the point of view of a 1-year time frame, I think the gold and the silver equities are likely the place to be. I'm not positioning there because I'm positioned. I have this paper coming out of every available orifice, horrible image, but that's the way it is. I agree a lot with Lobo with regards to copper. I like the copper business because there's any number of copper mines in the world that make $2 or $3 million a day. And I have a fondness for big deposits as opposed to small deposits. The copper business has treated me extraordinarily well for 40 years, so I'm predisposed to it. I'm a bit more cautious than Lobo, which is unusual, in the near term about the economy. I'm not an economist, but I note that the oil price falls even on flat oil production. That tells me something about near-term demand in the economy, not what people are looking to in the future. But I would agree with Lobo that to the extent that we see copper weakness as a consequence of the global economy, that we view this as a gift. If you look out further, for every reason in the world needs more types of power of all types. And copper is how you get it. Well, it's how you generate it. It's how you get it from where it is to where it's needed. And it's how you use it. There's 1 billion people on Earth with no access to primary electricity. Those are all copper buyers, whether they know it or not. And we all want to use more energy. It makes our life better. My own particular thesis is that I'm a commodity agnostic. I like great big deposits, Tier 1 deposits, sort of $20 billion in net present value at today's prices, in recoverable reserves and resources. And I don't care about the commodity. What that means is that I'm looking at Tier 1 deposits in out-of-favor countries in out-of-favor commodities. Things like rare earths in Brazil, things like rutile and graphite in Zambia. 6 months ago, before it became popular again, platinum and palladium in Brazil. I have a huge fondness for great big deposits in out-of-favor commodities in out-of-favor countries where the market ignores it. The idea that there is a deposit that could in 5 years be worth $2 or $3 billion that has a market cap of $50 or $60 million today is particularly seductive to me because I've enjoyed it so often in the past. I look for companies that have a management team with a proven track record of success in the task at hand. If somebody has been successful developing copper gold porphyries in the South American Cordillera, I want to buy a company where a proven team is developing a copper gold porphyry in the Chilean Cordillera. I'm, as I age, increasingly attracted to the Buffett thesis that ideally you would put all your eggs in one basket and watch that basket very closely. I have never been as good at stock picking as Mr. Buffett, so I've always had to have some diversification to protect myself from myself. But selection in earlier stage companies around people, and people is important. And it isn't just people. It's people performing tasks that they are proven to be successful at. I can't stress that enough. As the company matures, you can take other things into consideration. But this theme, pick a theme, diversification, anything like that. It's less important than an incented team engaged in a task where they are proven outperformers. Look at the success of the Lundins right now in NGEX. What are they doing? They're exploring the Argentine Altiplano. They've been doing that now for 3 decades. The team who is doing it for them has been doing it for them for 25 years. They have worked, if you will, 3 decades to be an overnight success. And I've watched this happen time and time and time again. I've watched the Ross Beatties of the world, the Bob Quartermains of the world, the Robert Friedlands of the world, the Lundins of the world. I've watched these people from humble starts with companies deliver serious outcomes. And if you're going to come down the quality trail, which both Lobo and I love to do, start the game with people, not story. Let the people tell the stories.
And so personally, I do look at political risk a lot in my portfolio. If a place has just had a coup, that's an absolute no-go zone for me. Even if it doesn't have anything to do with mining and the junta says, oh yeah, we want the mining to continue because we want the tax revenue. That's today. Who knows what they'll do tomorrow? Just look at what's going on with Mali, for example, of rug pulls and rule changes and things. I do think this is important. But to your question, though, multi-asset diversification kind of helps, but not much. If you've got a big mine in some country that just goes bananas, it's going to hurt. Look what happened to Franco-Nevada, which isn't even a miner. It's a royalty company, supposedly safe, right, from operational difficulties because they just collect the royalty. And then Cobre Panama happens, right? So to me, in my investment time frame, in my business model, this is material. And it's a big problem for me if I tell everybody, don't worry about it, it's fine over the long run, and then they get hurt and they don't have the intestinal fortitude to ride that shock out or actually see it as a buying opportunity. So this matters to me a lot. Diversification kind of helps a little, but generally I just avoid, obvious danger spots. There are no-fly zones for my money, and I say so to my clients.
Effective portfolio construction in the precious metals space typically incorporates key elements. A balanced approach might allocate 30 to 40% to physical metals and 60 to 70% to mining equities. The overall stock market has remained relatively unchanged this year. Meanwhile, gold is soaring, and gold stocks are up about twice as much as gold. Are you positioned to take advantage of this precious metals bull market, or are you still on the sidelines waiting for confirmation that may come too late? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.